Portfolio Builder members, welcome to our January 15th trade alert, closing out a substantial profit on the SPY. Now, I did delay the trade 30 minutes today, so I apologize for the delay. I was hoping we could pick up another $1.20 profit, but the ceremony is an hour in and they're still just announcing who is part of the deal. So we still haven't seen any of the details, and our long-term predictions for 2020 remain intact. That's a SPY traveling towards 360 by summer, approximately a 10% return from here, and bond market having some trouble. Let's just take a look at the results of this current trade and look at the new trade. Okay, here was the most recent trade, which was to sell the 330 call and to buy the 324 put expiring today. We started off with a debit on this trade of 18 cents and had to pay an additional 4 cents to close out the trade. The profit was delivered from the underlying asset appreciating, traveled from 326.82 on Monday as of entering the option trade, as well as having the lot of 100 shares of the SPY, and did progress to 328.84. So we made $2.02 on the SPY. And we lost 22 cents from our option caller, which again provides the downside protection. And of course, we like to have downside protection in this program at all times because our goal is to generate low volatility profits. Now, I have included the SPY returns separated, as well as the total returns below. So we can take a look that we've been doing quite well on the SPY, even with put option protection and selling call options the entire time. So that acts as a drag on our returns, but we did return 1% in October, 2% in November, 2.2% in December, and at 2.1% in January. And again, I think there is a rise of approximately 10% ahead for the SPY, primarily due to US deficits forcing the Fed to grow its balance sheet. And I'm expecting the Fed will continue to grow its balance sheet by between $50 and $100 billion a month. We just pushed a massive amount of debt through Monday. Another huge load is selling today, upwards of $150 billion being recycled in T-bills this week. So quite surely this Friday, we should see the Fed's balance sheet grow substantially. And if the number of SPY shares remains the same, but the money supply is going to grow by $500 billion plus per year for the foreseeable future, there's no end in sight in our deficit spending, then the only thing that's going to hold back stock market growth will most likely be credit tightening, which has not occurred yet. So my look at the SPY ETF is that it's clear coast ahead with very little risk in the short term, especially now that this China trade deal is officially being signed. So we'll have to look at the key details after our webinar today, and I'll report to you guys on what are the details, what are the nuances tomorrow morning. But let's take a look at the current trade alert, and then I'll come back to our open positions. Okay, so the first step was to buy to close your 330 call and to allow your put option to expire worthless. It was only worth a penny, so you won't be able to sell that, but you will have to sell, or rather buy to close your call option that you sold in order to roll into the next covered call. The next trade alert is to sell the 332 call. And if you're wondering why we chose that, the two strike prices that have the most call option writing are currently the 330 strike. There is a massive, massive amount of money sitting at the 330 strike. The next largest strike on the call option side is 332. So that means that people who own the SPY are going to be forced to sell their shares at those two strike prices to call option buyers. So we'll just see how bullish the reaction is today and into Friday with this current trade. Now, we still purchase downside protection in case anything goes wrong, liquidity dries up, a lot of selling were to occur rapidly. We can really take the the bite out of any kind of pullback by buying these cheap put options. So we have the 326 put for a cost of 30 cents or $30 per contract. Now, again, this is based on lots of 100 shares of the SPY. So if you have 100 shares of the SPY, you would place one option contract. If you had more, then obviously for every 100 shares, you would increase this by an additional option contract. So if you had 1,000 shares of the SPY, you'd be doing 10 of these contracts. Here's a look at the profit loss we can achieve on this trade. Very similar to the risk profile of our previous trade. If we do look at the x-axis from left to right, as though you're looking at the horizon, you can note that on the bottom, we see the price of the SPY. And this is representing the price of the SPY at expiration. If we look up and down on the y-axis, we can see the profit loss. And what you'll note is our profit is cut off at the price we've sold the call option, which in this case is $3.32 for a maximum profit of $300 per lot of 100 shares of SPY, or $3 per share, while our maximum loss is also approximately $3 a share. So the losses get cut off where we've purchased our put, and on the other side of the trade, our profits are cut off where we've sold the call option. So that's our setup going into Friday. Let's take a look at the rest of our positions. Okay, the first position to take a look at is emerging markets. We did close out a relatively large profit on Tuesday, yesterday, on emerging markets, and it is a little bit lower today. My expectation for emerging markets is for it to get past its all-time high of 52 seen in 2018. And remember, going into 2019 was the year when all the central banks of the major economies were trying to hike interest rates and remove liquidity from their money supplies. And eventually we saw every asset under the sun, including US stocks, crash by year end. And this was from a credit crunch. Now, first it hit cryptocurrencies, then we saw emerging markets crash. By year end, the 10-year yield hit over 3% in the US, and that tanked the US stock market and forced the Fed and all the other central banks to completely reverse policy in 2019. And now they've been cutting rates, which was very bullish for bonds. And next, they've rotated into quantitative easing, which is very bullish for stocks and very bearish for bonds. And like clockwork, we've seen rate cuts create a positive environment for bonds, and quantitative easing creates a positive environment for stocks. So that's our primary focus going into 2020, is to look at the increases in the Fed's balance sheet, as well as other primary central banks, including the ECB, as well as the Bank of China and the Bank of Japan, all creating fiscal deficits as well as increasing their central bank's balance sheets. So the basic idea is that the number of shares of companies will remain flat in these assets we're playing, but during this period of time, we're expecting the relative amount of money to be increased. So the money supply is increased and the number of shares remains flat. That means the value of stocks must rise. And so that is how we're seeing stocks, especially in the S&P 500, greatly outperform earnings, and simply seeing expansions of its PE multiple. Okay, gold, we're flat. Again, this trade, I was expecting some short-term volatility, but as we do see the balance sheet grow, I expect GDX to rise. With this play, we have the long 29 put, which was an in-the-money put when we purchased it. We paid $1.59. Now, keep in mind that does have some intrinsic value because we bought a put option at a strike above the trading price, in fact, by 88 cents. So that is 88 cents of intrinsic value. And in that trade setup, we've essentially locked in our maximum loss the second we place that trade and just sit back and wait for GDX to appreciate. So GDX represents 10% of the portfolio, and we locked in a maximum loss of 2.5% the second we bought that put. And now we just have to work off the put and allow it to appreciate. And the goal is to catch at least a 2.5% move up in GDX by February 28th. I think realistically, we could catch more like a 10 to 20% rise, assuming that the Fed does continue to grow its balance sheet. Now, keep in mind, the last 2 Fridays were somewhat of a letdown for our anticipation of growth in the Fed's balance sheet. We've been seeing a normal $25 billion increase per week or $100 billion per month, only to be let down the last 2 Fridays where they grew it by $10 billion 2 weeks ago and reduced the balance sheet by $25 billion this Friday. Now, I think they were seeing that the China deal would probably support markets and that there was a massive amount of T-bills being sold this week. So I do anticipate come Friday, we will see that balance sheet growth continue. TLT, we pulled a really nice profit last Friday, or rather last Thursday. And it was a lot like this setup where the second we placed the trade, it went against us. But by the close of the week, the TLT had sold off. So we caught a really nice profit last week on the TLT. Currently, we're down $1.96 on this position, assuming you're assigned. And so you'll be in potentially a cash position tomorrow and only long your put. So this will be our trade tomorrow. And I'll give a detailed analysis of the bond market going into our report tomorrow. But the outlook for TLT remains the same, and we'll most likely continue the exact same trade setup. The total return, even while holding that TLT loss, is 0.3% in December, or rather January thus far. So we're off to a good start, and I think we can see the TLT sell off in the coming days. Now, I will be willing to hold that position on the TLT until Friday if it does look like the momentum's moving in our direction. So we'll keep a lookout for a potential delay on the Thursday trade. Regardless, we'll do the full analysis and webinar and evaluate the position. GDX, we have no action to take until February 28th. And so now we'll see just how far the stock market can rally before yields start to slow its growth down. So that's my anticipation of how this is going to play out. All right, guys. Now, I didn't put together a big news piece today because I've been looking for as much detail on the China trade deal. A few highlights are primarily that the numbers coming in are much greater than what they had been announcing. So now they're talking about reducing the trade balance by $200 billion, which is much larger than the growth of just the simple agricultural purchases. So I think this is going to be very bullish for U.S. equities going into 2020, and definitely removes a major fear that was keeping the bond market at such low yields. Now, today we did have a very weak PPI print in terms of inflation for producing goods in the U.S., which does signal that productivity is keeping inflation low, and that the Fed most likely can get away with increasing this balance sheet for quite some time before inflationary pressures really force them to hike rates. But with the economy doing so well, I just don't see any rate cuts in the near future, which is what would push the TLT dramatically higher. And instead, I just suspect they'll keep rates flat going into most of 2020. And so this means we want to be long equities and short bonds. Okay, guys, I'm gonna go ahead and open up for Q&A now. And we have 20 live. Thank you guys for joining us. Let's see, we got Ed Danzo. Thanks for joining the boot camp yesterday. Ernest, Kenneth, MG, Peter, Dave Magaro, Henry, Karen, Murray, Ron. How's it going? Let me unmute everybody. And let's see what questions we have out there. And quite a few names I don't know yet, so hello to everyone. Okay, guys, I have unmuted the audience. So if you have any questions or comments, please go ahead. Where are you at, Karen? We always count on you for a good comment.
Sorry about that. Yeah, no, I'm in Tennessee. I'm catching up. I got busy yesterday and I had a doctor's appointment this morning, so I went flying back in the house when I got the alert. I said, oh my gosh, I'm glad you're late.
Oh, man. Oh, good. Well, hey, sometimes it worked out.
Yeah, it did.
We keep having these critical pieces of news right when we do our trade. So,
of course.
Oh, well, we're just trying. I was trying to be a stooge and pick up an extra dollar. So it's not the end of the world. But yeah, that ceremony is just dragging on and slow. It's more like a sitcom than getting to the beef of it. So.
Oh, I must have to watch it. I was listening this morning to the debate between Kyle Bass and Bannon. It was interesting, and then I heard what's his name? Oh gosh, my mind. Sorry, I'm trying to juggle a little too much here.
Kudlow.
That's it. Yeah.
Yeah, he was on this morning.
Yeah, and of course that was quite interesting. So we're watching the market move with everybody talking about it. Was just hilarious.
Yeah, I'll show you guys.
I had to run out of the house, so I was touched for a little bit. So it is interesting. So I'm counting on your research now to catch me back up again.
Okay, good. Well, here's an interesting chart I wanted to show you guys. So this helps us choose our strikes. Zoom out a minute here. Okay, so this shows you the total amount of capital at stake at each strike. And you can see this 330 price has been the, let me refresh it. 330 is just a massive, massive resistance line where a lot of SPY holders have agreed to sell their shares by selling call options, just like we are. So I think that's going to be contested this week. And that's why we had chose the 332. I was hoping to do the 333, 327 option collar, but we needed it to push up another dollar to that 330 line to get away with that. So we did end up going just one strike lower with today's trade. Oh, let's see. Murray's got. Do you got your microphone today, Mike? Murray?
Yes, I do.
How's it going?
Well, looks like the trade deal appears to have more extensive things than I was expecting.
Yeah, it looks like they're going to buy a lot of stuff. So
let's see if it really happened.
I think here's what the big hiccup was yesterday, and I did see a good comment on this. We're getting a little. I'm just going to mute you for a second, Murray, because it was echoing on me. Let's see, where's the echo coming from?
Honorable President Donald Trump, Honorable Vice President.
Okay, sorry guys, I was getting an echo. So yeah, the big hiccup was that no plans to roll back any tariffs was one thing that I think has the market concerned that came out last night. But perhaps Trump's real intentions are to have one more ace up his sleeve to roll back tariffs, perhaps in October, for another relief rally into the election. So that might be, and also they're still trying to press hard for phase 2. Now we don't even know what's in phase 1. So we'll shortly get those details, and I'll definitely be reporting that tomorrow in great detail. We'll also be deep diving into what's happening in treasury markets and bond markets worldwide, and try to get a look at how our TLT position is going to play out for us. All right, guys. Well, I'm going to go ahead and do a quick recap of our strategy and our trading plan. Give you guys another chance for any questions, and then we'll prepare for tomorrow's trade alert. This is a look at our trading plan. It allocates your capital into equities, bonds, and gold. The SPY represents 40% of our portfolio and is traded Monday, Wednesday, Friday. But keep in mind, because we use options, we can make our trades profit regardless of the direction of the asset. So sometimes we can play the market bullishly, bearishly, or neutral. And just by simply optimizing our option contracts, we can derive profits. Today's trade is a bullish loose option collar, and one of our favorite go-to strategies in the program. On Tuesday, we're playing the emerging markets. And currently, we're using a married put, where we simply buy a cheap put option and hold the asset week to week. Now, in this position, we're expecting emerging markets to walk its way up towards its most recent high at the end of 2018, towards 52. And then I believe it can break into new highs and get towards the $59 to $62 range. So while I do see the potential for SPY to rally towards 360 for a 10% gain by summer, I think that emerging markets could outperform it by a 2 or 3 to 1 ratio for potential 20 to 30% run up going into the first 2 quarters. Now, if there is quantitative easing at all the big central banks, it has always, without failure, been negative for the long end of the Treasury. So I am expecting, without Fed intervention, which would mean either cutting rates or starting to do quantitative easing in the middle or the long end of the Treasury curve, that we should see a sharp sell-off in the TLT going into the first 2 quarters of 2020. So I still remain bearish on the TLT, and we'll be deep diving into that analysis tomorrow. In that position, we are using the inverted option collar, which does allow us to create a setup where if the TLT trades flat or down, we can benefit and generate profits while holding the asset, which does give us a little more room for error, as it can be difficult to time different important assets such as the US bond market having some turbulence ahead. So that's why we do that versus just buying put options or just buying an ETF like the TBT. So the benefit of the inverted option collars, we can generate profits from time premium eroding, plus from being long the put. So that is a safer way to generate consistent returns in that prediction. GDX, I do expect, could have some volatility on the ease in the US-China trade tensions. But the real reason I like to own GDX is not because of a fear of growth, which is why we would be long TLT, but rather a fear of central banks increasing the money supply at too great a pace and causing inflation. So my expectation for GDX is modest growth in 2020 as we watch the Fed's balance sheet grow, and then much more aggressive growth into 2021 and 2022 as the Fed begins to get cornered into a position where they have to start cutting rates again and then going into real quantitative easing. And really, it's hard to change this course without either a major crisis, which seems unlikely ahead of the US elections, or if the US government were to stop creating so much debt, which also seems extremely unlikely as they already have a 2-year budget, which essentially locks in these deficits that are going to be continuing to put pressure on the banks, and the banks are refusing to lend money because of all the treasuries they're purchasing, which is why we're seeing the Fed starting to take them off the bank's balance sheet and sweep them under the rug into the Fed's balance sheet. So with GDX, we're playing it a little more patiently. We're trying to save some money on our puts. And in that manner, we're simply buying a 2-month put and sitting back until February 28th to sell that put and buy a new one. And so that will most likely be the trading plan for GDX for quite some time. Target return is 1% a month. However, if there's a major crisis developing, and I think it's prudent to play it safe, we simply put our position to be long stocks and long bonds at the same time. And this makes it very hard to lose money and is a great way to protect our portfolio. But currently we are in a de-escalation in the trade war after having been overbought in the bond market. So again, our anticipation is for the SPY, emerging markets, and GDX to rise for the first 2 quarters in 2020, and for the long end of the treasury curve to see rising yields or a falling TLT. Now, as treasury interest rates get too attractive, I think that will dramatically slow down the rally in equities until it eventually causes it to sell off. So the timing of calling a top in equities will probably be easier to predict, not but based on the exact price of equity markets, but rather watching the bond market work its way up towards 3%, which is exactly how far the 10-year got in 2018 in September, before we saw that 3-month crash, and then again forced the Fed to go into a period of easing, cutting interest rates 3 times last year, and now going into quantitative easing, which again is their playbook that they've used over and over and over again in history. And it's almost had a 100% track record of creating bullish stock markets during QE and bearish bond markets during that period of time. And then when they cut rates, that's almost always in the face of stocks crashing or shortly thereafter, which we saw again at the end of 2018. And then they rotate into quantitative easing. So I think we can suspect quantitative easing for at least the next 3 to 6 months. And then if they start to slow that down and at the same time rates are rising, that's when I'll be ready to call a top in equities and want to trade it the other direction. So for bag holders buying and holding stocks, they might have a few more good months ahead, but I don't think it will be long-lived until we get quite a sell-off at some point in 2020. So those are our market predictions. If we do look at our track record, this is with all of our strategies combined. You can see we began in December of 2018, right in the middle of the crash of the Christmas massacre. It didn't phase our strategy because we were long stocks and bonds. Trade war was still well in effect. Did well throughout most of 2019. We had one losing month of negative 1% in July. And I was preparing our portfolio for trade war escalation. My thought was that if Trump is going to escalate the trade war, he better do it sooner than later. Otherwise, he may risk putting the U.S. into a recession, which would make it extremely difficult, if not impossible, to run for the 2020 election, as his entire campaign revolves around strong U.S. growth. So that was our only loss in terms of a month start to a month end. And again, I want to point out that we have generated 16.87% return over the course of 13 months now. And our greatest loss closing out from a month start to a month end, again, is negative 1%. So we can say that we've risked $1 to earn 16.87 cents over a period of 13 months with this very conservative, safe trading strategy. Now, keep in mind, in 2019, the entire time, almost without exception, we were simply long stocks and long bonds. We had a few bearish bets. And so whenever there were sudden quakes in the stock market, primarily December, May, and August, you can see stocks did fall 15%, 8%, 8% in those 3 periods of time. And we were not scathed. In fact, we had a positive return during those months. Now, going into 2020, our positioning, at least for the first 3 to 6 months, is much different than 2019, again, we are betting on a rise in yields, which will create a sell-off on the TLT, and a very bullish stock market fueled by the government forcing the Fed's balance sheet to increase. So another thing I am keeping track of closely is to monitor foreign investment in U.S. Treasury auctions, because that can relieve some pressure on both bond yields, plus the Fed having to pick up so much debt out of the U.S. banks and grow their balance sheet. So as the yields rise, that will help the bond market take some tension off U.S. banks and most likely slow down the growth. So it's kind of odd to think that the U.S. deficit is the key reason to be long equities right now, but that is the case. So that's a good overview of our plan. Each day, depending on the asset we're closing, I will update the individual track record. So if you do feel like you just want to follow one of the asset classes, you can always do that. If we do look at the summary, in the SPY portfolio, we have returned 17%. In the equities portfolio, delivered on Tuesday, which is emerging markets, we have delivered a 16.6% return. Our precious metal and cryptocurrency portfolio has had the highest return, but of course, dramatic volatility. So it does come at a cost. There's no free lunch. 37% return, which again is traded on Thursday in tandem with our bond portfolio. Now, the bond portfolio had been leading the race for most of 2019. It's currently only returned 12.7%, although the crash I am expecting in the TLT is about 11.7% from here to go to 120. So that can be very lucrative to catch that move with our inverted option collar. So again, I do anticipate this move will last anywhere from 3 to 6 months until we do get a major reversal. So depending on the timing, could see rate cuts happening somewhere in Q3 or Q4 of 2020. And then we could see the exact opposite happening, which would be stocks selling off rapidly and a big push in the TLT. Now, long-term, I think TLT can break into new highs as we do see the Fed using forward guidance now to indicate that they do intend to drop rates to zero, potentially go to negative rates. We're talking about lending directly to hedge funds, all kinds of very socialist, nonsensical ideas to try to expand the business cycle and not let the inevitable occur. So for me, looking back in time, I like to look at 1965 through 1970. Had this huge stock market rally, seemed like nothing would ever stop it. We had a lot of spending, and then eventually we got inflation through the 1970s, and we had to have interest rates get hiked all the way up to upwards of 18% with Paul Volcker. And that's where you get your negative stock and bond market returns, as well as precious metals. So by having our asset classes that we have, and by using the option market, we can take advantage of all of this and play the big macro trends. Also, one reason I do like our exact portfolio is it does make us pay attention to the most critical parts of the world economy. So we're really playing the biggest markets there are: the US bond market, the US stock market, China, and then of course, the inflation hedge with gold. So by having these assets, it does make sure we don't get sideswiped by zooming in on some sort of micro strategy where the big picture could just wipe out whatever it is you're doing. Okay, guys, let's go ahead and see if we have any questions, and then we will prepare for tomorrow's presentation. Ed, I know you're just joined the boot camp, so any questions from you?
And Cameron, I know you're new here. Please feel free to jump in, ask any questions you might have. Kenneth, here, please feel free to jump in, guys.
I just stepped out for a second to go watch the quote unquote signing.
Oh yeah, any good details?
It's, you know, it's just me watching body language and, you know, my observation. I don't know.
They're just
We'll see
dragging it on as long as they can, huh?
Well, they just finished the signing. They're shaking hands. They're, you know, the pictures, the phony smiles, you know, it's, I don't think it's exactly what they expected, but we'll see. I think they're treading very carefully both sides on this, so we'll see.
Yeah, absolutely. Okay, we got a question from Peter. Go ahead.
Can you hear me okay?
Yes, sir.
Okay, great. I was looking at the SPY put, and it looks like we're buying a put option that expires like in 2 days.
Yes, sir. So that's the big advantage of the SPY is that it has options 3 times a week. So it allows us to essentially track the price of the SPY and kind of hover right below it. So it's almost like a safety net for your nest egg by constantly having that put option. If there is a massive sell-off, you're going to be caught in your put option, almost like a hammock sitting underneath you. And so by following the price of the SPY every Monday, Wednesday, Friday, you'll see I'm going to constantly have a put option protecting that big chunk of your portfolio at all times. And oftentimes we can pay for it, or at least the bulk of it, with our call option we've sold. So we can finance that for.
Okay. What is the call option that we're selling this week?
So we sold the 332 call for 11 cents and purchased the 326 put for 31 cents. So the net debit is 19 cents. Now I entered the trade at 328.83 and I think we're currently at 328.20. So you might, if you're just following the trade now, you're going to see that you'll collect a little less on the call. You'll have to pay a little more on the put. And I think it'd be perfectly okay to drop the strike on both of those by 50 cents if you do want to get a closer cost basis that I had.
Okay.
But if you took the same strikes, it'll be very close return. So it's. Did you take the previous trade or are you just starting with the program now?
Well, this is my second day. I'm still a little confused and really don't feel I'm smart enough to answer or ask questions. So.
No, keep going. That's what this is all about. We also have a boot camp that I think you could potentially find of interest. Yesterday we did a 2-hour session where I just drive all this terminology through you from every angle you could imagine. And this was just part 1 of about 6 of these lessons.
Okay. Yeah, I'm used to purchasing options, but it's normally for a longer period. Of course, it's for a different purpose. So.
Have you ever done a covered call?
Not really. No.
Okay, so that's really the kind of the bread and butter of our whole strategy is we're going to own the asset. By owning the asset, that puts you in a situation. One sec, let me mute the audience except for you.
There we go, Jay. Now the feedback's gone.
Okay, good. So the bread and butter of this strategy revolves around, let me ask you this. Have you ever been in the real estate business, renting out a house?
Yes, I have.
Okay, so that's something that people can really relate to. If you own 100 shares of the SPY, you basically have a high demand condo, let's say in New York. And now you could use something like the Airbnb app to rent it out frequently for a high premium. So that's a lot like what our strategy involves when we sell a call option against our shares of the SPY. And so because the SPY has this opportunity 3 times a week, it means we can be generating income from our underlying asset 3 times a week. Now, it's not exactly like owning a condo, obviously, and there's downside risk to the SPY selling off. So we don't want to just blindly own the SPY and hope for the best. And that's why our strategy does protect to the downside by also purchasing put options. Now we can optimize this option trade in a number of ways to benefit from what we anticipate will occur in the future. So in this case, I do anticipate the SPY will continue to rally between now and Friday. And so we enjoy profits up to the strike where we've sold the call. In this case, that's 332. But if we're wrong or something unexpected happens, suddenly stocks sell off rapidly, well, guess what? You're not going to lose as much as everyone else. Your losses are cut off the second the SPY goes below that 326 put. So let me go to the risk graph. So this daily risk graph will tell you the best case and worst case outcome for each trading period. It cannot get any better or any worse than this risk graph indicates. So the maximum profit we could generate between now and Friday is $300 if the SPY travels to 332 or higher. It doesn't matter how high it goes, we will make that same profit the second it gets to 332. On the flip, if the SPY were to sell off for whatever reason, then we still get a minimum of 326 per share because we bought that put. So that's really the bread and butter of our whole strategy, is being able to take in constant income from selling call options and to be able to have constant downside protection. And because we have the downside protection, this trading plan is much easier to follow than anything I've ever seen. And I've been doing this business since 2008, have represented everybody under the sun. And
Yeah. It's very ingenious. Okay, you guys are pretty smart.
you like it? Who's that out there?
There's Pete.
Pete.
Peter.
Oh, that's Pete. Oh, okay.
Yeah, Jason, this is his first webinar today. He's calling in from San Diego.
Nice. We love San Diego. I guess who doesn't, huh?
I'm actually in Pensacola.
Oh,
no.
I'm sorry, Peter. That was Kenneth I was speaking to earlier. My bad. Sorry about that, Peter.
I love San Diego too. I live there. I was in the Navy and been around the world a couple times.
Oh, nice. Yeah, my uncle was captain in the Navy. I always like visiting his little abode up in Colorado. So here's a big advantage to our trading plan, is that because we have this constant put option under all of our assets, and I mean all of our assets, there's never an instance where we need to rush to our computer to place a trade. There's no emergency trades. There's no risk of losing a lot of capital from any trading period. Our maximum risk is defined at all times. So we know at all times what's the most money we could potentially lose over a period of a week. And so that risk parameter is really what separates this from many other trading plans. So number one, you know exactly what we're going to trade, when we're going to trade it. Without exception, there's absolutely no reason we would have to rush into some sort of emergency because we were in a risky position. We're just not. We have put options below all assets at all times. So that's one. Two, we know what we're going to trade and when we're going to trade it. So everybody gets the fill at nearly the same price. And then three, we're trading the right assets. So we're not going to get blindsided because we're paying attention to the biggest forces in the market. So a lot of people can get zoomed in a little niche and do really well. And then all of a sudden a bigger force comes in and wipes out their strategy, and they didn't see it coming from a mile away because they're zoomed in on the micro details of whatever strategy it is that they were focused on. And so the result is, whether we're winning or losing, our audience gets the same result predictably and on schedule. And so far, we've done quite well. If you're not worried about missing out on returns and you're more concerned about protecting capital and safely growing wealth. And also, I'll be the first to admit, I like to call myself Paranoid Pete, Negative Nancy, Scared Sally, whatever nickname you want to come up with. If I see anything at all that could be a large risk to our portfolio, we immediately go into a very defensive stance that makes it extremely hard to lose money. And notably, I would point out the low returns from September up to November as more of a selling point for our portfolio. That was a dangerous point in time where the trade war could have gone either direction. And if it had not gone in the direction it did, we would be having some very healthy returns over that period. But despite not having an escalation in the trade war, we still squeaked out some gains and played it safe. And so that's one thing that I know our clients can boast about, is they do feel safe every night when they go to bed, that they know not only is the assets in their portfolio, specifically the put options, protecting their retirement, but that their team doing this research is obsessed with trying to find problems before they have happened. And so that's what you can expect in this program. And I do appreciate your questions. Any other questions, guys? Pete?
So if the option is going to expire on Friday, the put option protection that expires on Friday, if something happens over the weekend, we'll have another option put on to cover us through the weekend too.
Exactly. Yeah. So now that's a really good question. I do want to point out some differences. So on the SPY, I'm buying put options that expire every 48 hours. So on the SPY, I'm buying options that expire every 48 hours, except for Friday through Monday, that's 72-hour period. And so you might ask, well, why don't we just buy a 1 or 2 or 3 month put so we don't have to spend so much money doing that? Well, the problem is, if we buy a put today and the SPY appreciates dramatically, which we anticipate happening, all of a sudden that put's going to provide no protection. So I'd rather sell a call option that I think will most likely expire worthless to finance my downside protection so that I can hover and follow the SPY as it approaches higher and higher levels. And that way, when there is a sell-off, our put option kicks in and it takes away usually around 80 to 90% of the sell-off is what we've seen typically we're able to reduce. Now, what's the catch? We're going to make a little less than the SPY all on its own. So there's no free lunch. But again, our goal on the SPY is to try to capture the returns without the volatility. And so if we do look at our SPY specific track record, and again, you can go look at each of these track records individually at all times. It's public, not password protected. You can see we've done just that. The SPY on its own has had 15% volatility in December and 7.5% in May and August. Yet the maximum drawdown in our SPY return is negative 1.2% in May. So that's the goal of this program. Try to take out the stomach aches, the volatility, and safely generate profits. So what's the other catch to this is that we have to be pretty dead accurate in our predictions. Otherwise, it's hard to generate profit. Now on.
Excellent. Thank you so much for that explanation. It really helps a lot. Sure.
And so with GDX, I'm not anticipating an immediate jump up. In fact, I'm expecting the potential, I'm expecting unpredictability in the gold market because I'm not quite sure why the Fed has reduced its trend of increasing its balance sheet. Assuming that the Fed does increase its balance sheet aggressively in the next, we got 6 weeks now until this put expires, then I think we can have a nice return on GDX. But if the Fed is slow to increase its balance sheet or continues to reduce its balance sheet, I was concerned that we could see some volatility. So that's why we have a longer duration on the put for GDX versus the SPY. Now, emerging markets, again, I'm expecting it to at least get back to its all-time high of 2018 and then potentially break through that. So you'll see I'll be taking more and more precaution as we get towards those levels. And this one is doing a 1 week put option each week with no call options being sold on emerging markets or GDX. Now, keep in mind, these two represent far less of our total portfolio than the SPY or the TLT does. All right, guys, any last questions out there? Well, I appreciate everyone's time. Tomorrow, I will have a detailed report on just what's in this China fact sheet. I will also have a very detailed analysis on what's going on in sovereign bonds around the world. So we'll be looking at all the major bond markets, specifically the long end of their treasury curves, and start looking for weaknesses, as I do anticipate rising yields in 2020, which again will cause a sell-off in the TLT. Okay, thank you guys. Really appreciate everyone, and we'll see you guys tomorrow.
Thanks, Jason. Appreciate it, guys. And people, if you have any questions at all remaining at this time, just give me a call. Be more than happy to look into any questions you may have, cover them in detail one-on-one. And this is Dean. My number is 505-322-7515. And definitely look forward to doing your investment coaching call with you. It's really fun to just go over, look at your total investment ecosystem and see how we can help. So definitely look forward to that process and hope you all have a wonderful day. And please call me if you have any questions at all, okay? 505-322-7515. Have a great day, team.
Thank you, Dean. Thank you, everyone.
Thanks, Michael. Talk soon, okay, bud? And Peter, I just saw you calling. I'll call you in just a minute.